Okay, let's unpack this. Welcome to the deep dive on Johnson Outdoors and their fiscal year 2025 results. That conference call dropped before the market opened on December 12th.
And if you were watching the ticker that day, you saw a masterclass in market confusion. It was a real paradox.
A paradox is the perfect word for it. You have this fundamentally strong operational performance buried under a really complex technical accounting headline.
Which led to just extreme volatility through the day.
Exactly. So our mission today is to get past that initial shock. We're going to dissect the full year performance, try to understand management's optimism about their second half momentum, and, really explain why the market reacted with such a huge swing.
Let's start with the basics, the results snapshot. For the full year, revenue was basically flat. It came in at $592.4 million.
Which was just a hair below the $592.8 million from the year before.
Right. But don't let that flatness fool you. The operational story was where the real action was. It improved dramatically.
You can see that in the operating loss, can't you?
That's the key. The full year operating loss narrowed by $27.3 million. I mean, it went from a loss of over $43 million down to just $16.2 million.
That shows some serious progress on their internal cost structure.
And they had a really strong finish to the year to back that up. Q4 net sales were robust, $135.8 million.
That's a $30 million increase over the same quarter last year. A really strong sign that their new products are hitting the mark.
It is, but here's the number that caused all the chaos. The headline, GAAP EPS figure. It was a net loss of negative $3.35 per diluted share for the full fiscal year.
And that's what the algorithms see. That steep loss figure hits the tape, and the reaction is just instantaneous.
Exactly. Completely overshadowed all that operational progress we just talked about.
So we have to cut through that noise. There's real margin expansion, there's strong execution, but then this massive GAAP loss. What's the one financial detail that created this disconnect?
It was almost entirely one thing. A large one-time $25.9 million non-cash reserve. They placed it on their U.S. deferred tax assets, or DTAs.
Okay, stop right there. That is a lot of jargon. If I'm listening to this, just trying to understand the bottom line, what in the world is a DTA reserve and why is it non-cash?
Sure. So think of a DTA as a future IOU from the IRS. When a company has a loss, they generate these tax benefits they can use later when they're profitable again. They're assets.
So it's basically a future tax break.
Precisely. But accounting rules require management to look at those future tax breaks and decide if they can realistically use them anytime soon. And because of some recent losses, Johnson Outdoors had to say, you know what, we might not be profitable enough soon enough to use all of these.
So they had to take a write-down on that future asset. No actual cash left the company.
Not a dime. It's just a required accounting admission of, let's call it temporary pessimism. And that pessimism means they have to carry this $25.9 million accounting ankle weight on their income statement this year.
That's a great way to put it. It's an optical disaster, but it's a one-time non-cash event.
It is. And here's the kicker. If the company returns to sustained profitability, that reserve can be released in the future. It becomes a huge non-cash tailwind to earnings down the road.
So it's a future embedded asset just waiting to be unlocked. That context is so important. Okay, so let's look at where the real operating progress came from. Those margins didn't just expand by themselves.
No, they expanded because of execution. Gross margin was up 120 basis points year over year, rose to 35.1%.
And what were the drivers behind that?
It was a mix of internal efficiencies. They cited better overhead absorption because of higher sales volumes, lower inventory reserves, which is huge. It means they cleared out old stock, and their cost savings initiatives.
And those savings managed to completely offset rising material costs, right?
They did. That cost savings program alone contributed over a full point to the gross margin this year. And they made it clear they have a whole new portfolio of initiatives planned for fiscal 26.
So this isn't just a one-off. It's a strategic priority.
Exactly. And while all this was happening, the balance sheet just got stronger.
Which is something the market often forgets in a panic. It looks incredibly healthy.
Rock solid. The company ended the year completely debt-free. That's rare in this space right now. And they have a cash and investments position of $176.4 million.
And you mentioned inventory. That reduction is a big part of the cash flow story.
Absolutely. Inventories were cut down to $170.7 million. That's a drop of nearly $39 million from the prior year, and it's why they had positive cash flow from operations for the third year in a row. That's just smart working capital discipline.
Okay, so that strong balance sheet is the foundation for their strategic narrative. Management kept calling fiscal 2025 a reset and stabilize year. What were the priorities they kept coming back to on the call?
The playbook was very consistent. They're investing heavily in consumer-driven innovation. They're pushing for more operational efficiencies, and they're expanding their digital and e-commerce side.
Let's get into that innovation. It drove that strong second half. What about the fishing segment? That's their bread and butter.
Yeah, fishing, which is Humminbird and Minn Kota, saw really strong demand. They specifically called out the new Humminbird Explore series and the Megalive 2 fish finders.
And the Explore series even won an Angler's Choice Award, which is not just a trophy. In that super competitive world of fishing electronics, that's a direct shot across the bow of Garmin and Lawrence.
It really is. It suggests they're taking market share based on having a superior product.
And it wasn't just fishing. Camping and watercraft also showed some surprising strength.
That's interesting because the watercraft market in particular has been struggling.
It has. But despite that, they saw really strong demand for Jetboil's new cooking systems and the Old Town Fishing kayak line. Both did better than they expected.
And what about in diving?
So Diving, which is their Scuba Pro brand, launched the new Hydros Pro 2 buoyancy device. It's built on an existing award-winning platform, and shipments started in December.
We should also touch on the portfolio cleanup. They exited the Eureka brand. That had to have skewed the numbers for that segment. It did. It definitely complicated the comparison. Management was clear that if you exclude the prior year sales from Eureka, the segment would have actually grown by 2% year over year. So it was a good move. It simplifies things and lets them focus on winners like Jetboil.
So what about the outlook? They didn't give formal numeric guidance, which is pretty typical for them, but what was the overall tone?
Cautiously constructive, I'd say. They focused on execution and the new products, but they were also realistic. They acknowledged the macro challenges and said it's still, too early to call a definitive turn in the outdoor recreation market.
And that's where you have to wonder, they're telling this great reset story, they're showing margin discipline, product momentum. Is this just a way to distract from that huge tax headline?
That's the conflict the market is wrestling with. I mean, you have clear operational progress on one side, and on the other, you have this stock that saw just insane volatility. Remember the swing? Yeah. It opened high, hit $48.15, then cratered to a low of $40.15.
And closed down almost 13% on volume. That was more than 3 times the average.
Right. And suggests investors just couldn't weigh the tangible improvements against the psychological punch of that non-cash tax charge. Perception beat reality, at least for a day.
It really highlights the central debate here.
Yeah.
Are the internal gains durable enough to withstand the, very seasonal and sensitive outdoor market?
It does. But the key fact that supports management's case is that the broader industry actually slowed in Q4, yet Johnson Outdoors sales rose. That's pretty solid evidence their new products are gaining share even in a tough environment.
So if the stock is going to get back to that $48 intraday high, what are the near-term catalysts we need to see in fiscal 2026?
I see 3 main things. First, you need to see proof that this innovation-led demand is broadening out, that it's not just a short-term launch pop.
Second would have to be continued discipline on the operational side. Right?
Absolutely. More cost savings, smart working capital management to keep that cash flow healthy. And the third, of course,
is the potential reversal of that big $25.9 million accounting charge.
That's the wild card. And on that front, the CFO did say that with the reserve now in place, they expect a much more normal tax rate for fiscal 26, probably in the mid to high 20s. So that removes a big piece of uncertainty.
So what does this all mean? Now it's time for the segment where we pitch a high-conviction, outrageous, but plausible trade idea based on this call. And remember, we are only discussing ideas. This is not financial advice.
Okay, so let's lay out the thesis. The market punished this stock for an optical problem, not a cash problem. That 12.7% drop on massive volume, to me, signals capitulation. It's a classic fear-based reaction to a non-cash event.
And in the process, it completely ignored the improved cost structure, the debt-free balance sheet, and that portfolio cleanup.
Exactly. The stock closed at $42.05, miles below its high for the day. Management has proven they can drive margin, and that DTA reserve is now a massive coiled spring waiting to be released in the future.
So what's the trade?
The outrageous but plausible thesis is that you bet the operational gains are real, and the market will eventually correct its overreaction. We're betting on a rebound toward the high end of that trading range.
And the specific strategy is a bullish risk reversal. Why that structure?
Because it lets us use the market's fear against itself. We start by selling deep out of the money puts, The panic around that negative EPS number has inflated the price, the volatility premium on those puts.
So you collect cash by selling insurance to the bears.
That's it. You monetize that irrational fear. Then you take the cash you just collected and use it to fund the purchase of cheaper, further out of the money calls.
What's the time frame and target on that?
You look about 12 to 18 months out and you target a recovery back toward that $50 level. You're basically getting paid to bet that over the next year or so, the market will finally start pricing in the real reset and stabilized story instead of the scary but non-cash accounting headline.
A really complex call then. A clash between strong operational health and some very confusing technical accounting. Strong Q4 sales, better margins, but a gap loss that caused a lot of chaos.
The whole story now is whether that innovation-led momentum from the second half can continue into fiscal 2026. If it can, it will stabilize the business and eventually unlock that DTA reserve.
Thank you for tuning into this deep dive. We really encourage you to look at how companies navigate this trade-off between technical accounting and underlying health. It's a crucial lesson in separating paper losses from real business performance.
And a final provocative thought for you to chew on. Management is laser-focused on efficiency, and they're sitting on a fortress balance sheet with zero debt and a lot of cash. Are they just waiting out the macroeconomic uncertainty? Or could they be building a war chest for a strategic acquisition, maybe in that beaten-down watercraft segment? Something to think about as we head into fiscal 2026.